Good morning, everyone. Welcome to another episode of Sunday Special. I've got with me Adam Lawrence and Helen Chorley. And
Morning.
shortly, we've got Jay Howard joining us as well. And today is a special episode. We're going to start, as usual, with the brief version of Adam's supplement and what's going on in the world economy and all the other places. And then afterwards, we're going to chat about construction projects, how to make them safer for everyone, including builders, including clients. And we've got some thoughts about this, and we're going to talk about this after Adam's supplement. So, Adam, do you want to give us your lowdown of your today's supplement?
Sure thing. Thanks, Piotr. So it was a bit of a mixed signals week. It felt for me like a week where there were a few things pulling in different directions, which is normally a good morning, Jay.
Welcome.
Which is normally a pretty good sign that things are actually improving in terms of certainly what people are forecasting. So because generally the news has this tendency to be somewhere between 70 and 90% negative. I would say, especially when it comes to property prices, but I don't think property prices are actually unusual. I mean, news is ultimately generally just a wall of negative stuff, isn't it, really? And then a joke story about rescuing a cat from up a tree at the end of the news to make out like everything's right with the world. I don't know what the property or economics equivalent of the cat stuck up a tree is, actually. We'll have to give that one some thought. But week of mixed signals. I used this week's graph, the RICS house price balance. So that's the number of surveyors reporting an increase in price minus the number of surveyors reporting a decrease in price in an area. So it spent a lot of 2020 beyond about March and April and May as a very positive number. It was close to 100 at one stage, which is one of the greatest signs of a crack up boom that you can possibly imagine. That's basically saying everywhere is going up in price. And it dropped to about minus 49, I think, or something like that, after the great Liz de Lettis had her impact, and we were at sort of the nut low early bits of this year. And the trend's improving, but we're still at like minus 30, which means 65% of surveyors are reporting prices in their areas going down, and 35% are saying up. That's the basic way to understand that. So it's a good leading indicator. It lets us know what's going on before it's going on, and the direction of travel is important. And the direction of travel is from minus 50 up towards minus 30 and probably rising. Although next month might be interesting because we've had this wobble with the interest rates, and therefore the mortgage product landscape has changed quite a bit over the last couple of weeks, and things are a little more expensive. I also talked a bit about it'll sound crazy to those watching who have been lamenting the rise in the interest rates over recent months, but actually the 5-year money, which is the money that we all tend to look at because we tend to use 5-year fixes, has been in a very nice place for some months, where the yield curve has kind of been up even more at the front end, which is a very typical sign of a looming recession. And then it's dropped a bit into the sort of 5-year point, and 5-year money's been the cheapest money of them all. And then it's come back up again into the 10-year money and beyond. And actually now the 5 years not that. And what that's effectively saying is that over the next 5 years, we're expecting lower interest rates on average, but higher interest rates in the longer term, which is a difficult one to get your head around. But what the market's now saying is, no, we've changed our mind. We know rates are going to have to be higher over the next 5-year average period than we thought they were. And that's what's sort of changing the prices. So when you're looking at the yield curve, you're obviously considering every duration of bonds, whereas really we're interested in 5-year. But I've made a case today that maybe we want to try and be interested in 7 and 10-year money, especially as some of these longer fixes do have 5-year commitment periods and 5-year ERCs sometimes. So you've got a 10-year fix with only a 5-year commitment period, which gives you the best of both worlds in many ways if things do go wobbly over the future term. And the recent the last 18 months has kind of proven to us, compared to Europe, compared to the US, who tend to use 30-year terms for their mortgages. We look a bit sick using 5 years because actually, let's face it, there hasn't been any real stability for the last 3.5 years, we could argue. And that's nearly a whole 5-year term of mortgage products. And those who've used 2 years that started buying stuff in 2021 in the middle of the year at elevated prices and perhaps paid too much are in that subset that are going to be in fairly significant trouble. Not necessarily negative equity by any stretch, but it depends how much they would want to sell. But we have to remember that distinction between prices and values at a time like this, where this is why we see far fewer transactions in the marketplace rather than prices really dropping like we might expect. But moving on from that, I had to have a little commentary because I was really surprised about really how bullish it was. Handelsbanken do a survey of their professional landlords, and they released the results. They've made some commentary on it. They're pretty strong with their economic side of things, Handelsbanken. I do like what their economist has to say. Normally, I'd say they have equal ability to some of the banks that are much bigger than them. But it's worth for everyone listening to this to understand, if you're not experienced with Handelsbanken, and if you're rate sensitive like most of them are, to an extent, why would you be? Because they're very rarely best price. It's not how they operate. But interestingly, we've got a Handelsbanken account, and I phoned them the other day to say that they're so security conscious. I can't imagine anyone's ever stolen a penny from Handelsbanken because their security layers are insane. But the little device, so if you've got multiple bank accounts, you'll know that those pin sentry devices, they're actually pretty generic. It doesn't really matter whether it says Lloyd's on it or whatever. If you put a Barclays card in it, it works, right? Not with the Handelsbanken one, though. The Handelsbanken one only works with Handelsbanken, right? And the battery was low, so I opened the back to look at what batteries they were, and they're those little flat CR2032 watch batteries. Didn't have any on hand. Ordered some. Got the batteries through Amazon, of course. Unfortunately, changed the batteries, and it seems they're so security conscious that even when you change the battery, the whole thing stops working. So I had to phone the branch in Solihull and say, can I have some new batteries? Can I have a new device, please? But the experience of phoning them is they pick up the phone. There's no IVR. There's no wait in the queue. There's like, oh, hi, Adam. How are you? You okay? Yeah, I'll send you one out through the post. No problem. It's like, okay, that's probably why people use Handelsbanken, right?
A person, wow.
A real person who knew me, yeah. And I've only spoke to him a couple of times via email over the years, quite incredible. So the typical profile of your Handelsbanken clientele is 65% LTV they consider excessively salty, and most they would think 60% on resi, 50% on commercial maximum. Repayment loans, although they might give you an interest-only period, they would never write an interest-only loan. They may give you a year or two at the front end to help with your cash flow or whatever, but they're not interested in any of that, really. Revaluations every 5 years, exceedingly pedantic on the legal side of things, very solid on the legals, very well secured. Can't imagine they lose much in terms of when they have to recover. Their bad debt must be teeny tiny, but they do understand they are old school bankers. They recruited a lot of people from places like Lloyd's and the high street in general who used to do it in a more relational banking way, and to an extent still do, although the problem is they're so squeezed on resource. Your relationship manager these days is looking after 48,633 accounts or whatever, so they can't really build much of a relationship, whereas Handel still do it in a way of like, fancy coming to the pub for lunch or something like that. It's proper old school. So their landlord profile is big portfolios, low loan to values, serious players who own hefty buildings, balance sheets in the tens of millions, generally speaking, and upwards. So you've got to respect their institutional nous and capability. And they were exceedingly bullish. 92% think their market, and bear in mind they're talking primarily about the commercial property market, which again we'd expect to be slightly ahead in terms of lag terms of the resi market, would be going up over the next 12 months. And I think it was 39% of them thought it would go up more than 20%. Now, they are talking from their Q1 experiences of offers on most things being down 15% or so, Q1 2023, and on industrial buildings 25% down. So you've seen a really dramatic dip as the market has really tried to adjust. Now, these are not necessarily, remember, the prices that things are transacting at. These are offers, and they'll also be reflected in valuations to an extent. But if you speak to most surveyors at the moment, if you're trying to value anything that's slightly out of the ordinary and has got a commercial angle to it, where they're suffering is lack of comparables. Because these guys and girls, do they need to sell their properties and things like that? No, they don't. They're sitting on the gigantic balance sheets. They're in it for the long term. They're not worried by a little wobble. But that tells you just how much the interest rate changes have bitten in terms of the value of commercial property. Obviously, it's very key with commercial values. But to be as bullish as all of that, I can't really have the 20% increase but that's based on my view that rates are going to be stronger for longer. And also, we don't know when this is the week the survey was published. Has the survey been out for the last 2 or 3 months? And some of these opinions might be slightly outdated or before this most recent wobble in interest rates. But fascinating to see. Lots are growing their portfolios. A small minority were looking to divest anything, about 16%, I think it was. Lots are growing, and some are moving out of region in order to get better deals, which is a trend that I've seen with the very big players that I know over time. I don't necessarily follow the logic of it. I think sometimes they just convince themselves that I think we can all be a bit anchored sometimes if we specialise in one particular geographical area, because we put the rose-tinted specs on and we say, we used to get those sort of things at this sort of price. And it's like, it doesn't really matter, does it? What matters is what today's value is, and then whether we can buy at value at today's value, and whether we're still... Now, I'm a big fan of diversification, don't get me wrong, but I wouldn't think if you've operated in Birmingham all your life, for example, where's your extra edge going to come from if you start operating in Manchester or London or Leeds or whatever? It seems to be counterintuitive to me. So I don't know whether that's sort of a bit of a grass is greener / rose tinted specs thing, but that's the overall. And then the messaging in general, we've still got a couple of weeks till Bank of England. The headlines that have slightly trickled out this week seem to be suggesting, and the market is suggesting, a 25 basis point rise. It's one of the first times where I've been vociferously in disagreement with what they're talking about doing. I don't understand the logic of not doing 50 basis points rather than 25 and 25, because it needs to send a message. And the market, as I read it, was looking at about 80% probability of a 25 bips rise, 20% probability of a 50 bips rise. And I think that's wrong. And that just tells me even more that the bank will impress me quite a lot if they do the 50 bips. And if they don't, I'll just blame the governor, because that's what I tend to do. But also, but it is that, well, the buck stops on the desk of the top man or woman, doesn't it, at the end of the day? So let's see what happens on that front. But overall, I think this is where the next couple of months I think will be really interesting, because there's clearly a lot of green shoots in there for the shortish end of the medium term. But I bet you that's not what we see reflected in the press over the next 2 months or so. I bet it's not. And we had, I think there was the only other little bits were Halifax first annual drop in the Halifax price index since 2012, which just shows how robust property is, really, doesn't it? 11 years without an annual price drop, and that drop is a massive 1%. And we're not talking about the 20% plus gain that we had in the 2 years before that, which just tells you what you need to know about media, realistically, doesn't it? But the real difference in the market from 12 months ago is way, way more than 1%. Because if you want to trade stuff, if you get RICS valuations, you're much more likely to be between 5 and 10% down. Or you could look at it the other way around. We were selling stuff at 5 to 10% above what it was worth on a valuation 12 months ago. So that's 5 to 10% you've lost without ever knowing that you had it, if that makes sense to anybody. So that there is actually really you could argue there's maybe a 15% gap between prices achieved last year and prices achieved this year. But of course, that's when you come back to the strength of, you don't necessarily need to sell. So now's a pretty rubbish time to sell stuff. Although check your local area, because 35% of RIC surveyors are reporting areas where prices are going up, right? So this is not a prescription for everybody listening in every town, village, city, or metropolis that they live in. Your local area knowledge will always trump the macro figures. It's more just to take the temperature, feel the gauge, and also, rightly or wrongly, it should be helping you in your negotiations if you're buying, and it should be helping you be robust in your negotiations if you're selling, because there are going to be two different conversations to be had there, and that goes at any time of any year, I think. So that's probably it's a fairly long one today. I've also popped in a thing. We're in the later stages of working out something that can. There's a few enterprising people who read the supplement who put it into a reader or a similar bit of software where it reads it out to them when they go for a walk or a run or whatever. But I'm looking to get a piece of AI to do that in my voice, as if you haven't heard enough of my voice by now. But something that sounds like my voice, and pop it in podcast format on my YouTube and also on the podcast platforms. So I want to have that up and running by the end of the month at the very latest, really, because I know I don't take my own advice, because I much prefer listening to stuff these days to reading it, but I also vastly prefer writing it to dictating it in voice notes. But let's not go on a rant 16 minutes in, because it's only 9:16 or whatever it is, right? So let's leave that one there. But I think we've got some really interesting subject matter. I don't know if you guys want to comment on any of that and what you're seeing in real time, because I think real time is changing quite rapidly at the moment, because when there's been a bit of a wobble, it's interesting to see how people react.
Well, I was quite surprised to get an email from First Direct about saving rates, and when I gone through this, it actually says that some of the savings accounts offer now 7% interest. It's up to like a specific amount. You need to lock it in for 1 year, but a 7% interest on savings is pretty heavy.
Is that one of the regular savers, Piotr, where you have to put some aside every month? Yeah.
That's the one. It's like you can put in between £25 to £300 a month. So it's not a huge amount of interest, but just the percentage amount is gigantic compared to what it was like a year ago or so. And then normal accounts.
What was that a year ago? Do you know? Was it like 2 or something like that, maybe, or less?
I think it was still like probably less than 1%.
Yeah.
Because it's it takes some time for banks to filter through those.
So I guess that's very much a marketing play, because then they can say on all of their marketing, we pay savers up to 7%, and then they've got the clicks, and then you find out if you want an instant.
I'm pretty sure the normal rates are about 3 to 3.5%. So, but still, it's a big upward.
Yeah. That margin's got to readjust between the borrowers and the savers, and that's the thing, isn't it? Really, because the savers have, although they've been kicked in the where's, this is their biggest problem, because are they better off at 4% rates or 3% rates or 7% rates with 9% inflation, or were they better off when they were getting zero, when there was zero inflation? The argument is obviously the latter, although the former feels better. Everyone, it's like Bank of England economist, everyone's getting poorer, or whatever the chat was a few weeks ago,
Yeah, all relative. Yeah.
Brilliant. Well, I think
Jay, I think there's some problem with your audio, mate. I'm not sure what's we're having to lip read.
Can you hear me now?
Oh yes, we can. The dulcet
magic. There you go. The old-fashioned unplug it and plug it back in again work. That's my tech advice for everyone today.
In the boardroom club IT department, we call that the Rod Turner solution. Yeah, absolutely.
I was just asking, in the last 12 months, there was a point at which bridging finance was cheaper than traditional lending. And that was, I remember thinking, it wasn't just the rate, it was the rate of arrangement fees that traditional lenders were putting on top of so it was like a 4% arrangement in some instances. So with the way rates have moved, are we at parity with bridging? Is bridging still more expensive? Is it cheaper? What are you seeing? Because you probably touch the bridging market more than we do.
I would certainly think so. I touch them on a daily basis, not to sound too Gary Glitter about the whole thing, but the reality is the margin has been squeezed to a weeny margin, really, over the risk-free rate of return of money. So wholesale, we're only paying 5 basis points more than we were 24 months ago, which is insane, really.
Wow.
We're paying rates that the IRR would be about the equivalent of what those companies' bonds are trading at in the secondary market, and they're kind of holding on to the fact they've got old debt that's at low rates, and they're because this is the argument, isn't it? If you're a bank and you work in a not in a deposit taking fashion, but in a sort of interbank kind of fashion with your mortgage lending, you go out and you secure 250 million at X%, and then you go and fulfill that book. So we've still got a loan that I've talked about before that's going through that's at 4.04% right now. That is obviously last year's rate, and that's because the application was 12 months ago, and the bank in question have been so bloody slow in progressing everything. But that 4.04 is still viable to them because they secured that money at 1.1 or whatever, and it's got their margin attached to it and a margin that they're comfortable with. So they filled their allocation, and it kind of has to work like that. Otherwise, there would be reputational risk. There would be all sorts of problems, because they could obviously look at that and go, well, hold on, we can lend that money out today at 7 or whatever. But A, it won't go out the door today. It'll go out the door in 6 months' time anyway. And B, they've got criteria to fulfill around that pot of money that they want to deploy, because having it not deployed is very inefficient for everybody ultimately. The bridging margins are squeezed within an inch of their life, really. And they were, in a similar way to what you just said, Jay. I know bridgers who are, without getting into the relatively complex conversation, a decent sized bridging company is often funded by a warehouse facility who will give them something like between 70 and 90% of everything they put out the door. And then it's funded, then the top slice of that funding in their capital stacks is funded by private money or private equity or similar. And there was a point where a company that I know, where the warehousing facilities are often linked to SONIA. So they might be on like SONIA +4 or something like that, SONIA +4.5. And there was a point whereas the fixed money, the private money, if you're smart, is on a fixed coupon for a period of time. And if your fixed coupon was at, say, 8%, let's say, which might have been a pretty reasonable for given that bridges are only lending at 70% headroom and often quite a bit lower, generally speaking, maybe if your fixed coupon was 8% and your SONIA money was 9 point something. So effectively the first charge money was more expensive than the second charge money. Wow. But I think they are, if you think about it, most of these are working on 5-year cycles. So on average, there's a 2.5 year period before the pain of these interest rates really, really kick in. And I mean, that it tells you a lot. That I was talking to someone yesterday who's got a corporate finance business, and he said in 12 years of operating it, he's never had a client go bust on him, and he's had 3 in the last 6 months. And all of those have been driven by the bank being able to go, oh, you've got C-bills loan that you've defaulted on. See you later. You're gone. And it's like, well, hold on a second. What about restructuring? What about no? Because the money's guaranteed by the government, and they've just gone plug wall. It's the whole plug it out, take it out, and don't plug it back in again. Basically, is what they've gone for, and just bump it and say, well, not our problem, mate. Not our problem. Government's problem. That was the expectation. We can't be bothered to try and ask, because they don't like recovery. They don't like bad debt. They don't want to go to the board and say, yeah, this month we got £594 million worth of stuff that's gone wonky. It's a lot easier to say we've got £250 million worth of stuff that's gone wonky, and we've acted very quickly on £350 million worth of stuff. Aren't we clever? For the executive team. And that is the brutal reality of it. So the government may have encouraged the wrong behaviours. And this is really typical, isn't it, of a policy that it's trying to do the right thing, but it ends up driving a different behaviour and does the wrong thing. So probably at some point the government, but of course they're not reactive enough in these situations, but they should probably act and try and force some restructuring of some of these loans and say, okay, well, because these 3 businesses that my friend was telling me about yesterday, they're all viable. they're all viable. It's a cash flow issue, right?
Yeah.
So should we maybe restructure those C-bills over 20? Some of them have been going for decades and decades. Should we restructure to a 25-year loan, which is still guaranteed by the government, rather than one with 7 years or 4 years or 3 years left on the term? That might be a sensible way to do it. Who'd have thought of such a thing? And do you know how to incentivize the bank to do that? Well, pay them for restructuring the loan. That'll soon sort out the behavior, But instead, people are losing. The only people who are going to win are the administrators always win. I mean, you know that one, right? But the only other people who are going to win are the people who buy the assets out of administration on the basis that the government guarantees kicked in and nobody's really, the official receivers blindsided effectively. So, yeah. But yeah, they're surviving on thin margins, Jay, and they're lending into what's a riskier environment, or has been a riskier environment. I mean, I think I'd probably argue it is going to get less risky than it has been, right? But most stuff that's been originated in the last 18 months will have been riskier than stuff that was being originated in 2016, 17, 18, 19. You pick your point of entry. But the bridges feel that it's a very competitive space, which, how many lenders were in the market in 2011? There's probably like 8 or something. And now there's 462 or whatever there is. And so they all feel they can't push themselves above the parapet. And really, maybe they enjoyed massive margins, certainly for periods in like 2021, and they were unrealistic, and they're just kind of trying to keep the business. And if you've got a bridging company, the big rewards are growing the loan book, really, because that's how you're going to exit, or that's how you're going to access cheaper finance. You might be better off doing, normally I'd say the other way around, but instead of doing £10 million worth of loans at a 6% margin, you might well be better off doing £25 million worth of loans at a 2% margin, because you're getting closer to the point at which you're going to be able to access that warehouse money or similar, or lower rates, because the higher you go up the hurdle rates, the more players are at the table with their big fat checkbooks looking to fund companies of meaning and means, basically, I suppose.
Yeah. But it's something we've talked about in different contexts again and again, isn't it? When incentivization kind of goes wrong. And like you say, that's a prime example of, yeah, of course they're going to pull the plug, because there's no incentive for them to do otherwise. But that wasn't the intended, it's a side effect. That was never, I'm sure, never the intended outcome of that policy. Ouch. Interesting.
So do you want to segue skillfully into the project bank account and the likes, Helen? Do you want to give us a lead into all of that?
Yeah, it does actually segue into that nicely, because I saw or was tagged or commented on a post on LinkedIn this week by Christopher Barber, who's the co-founder of Prosper and of C-Link as well. And he was talking about PBAs, which, in all honesty, I'd never heard of before, but project bank accounts. And the post caught my attention because it was about setting up a specific bank account. He said lots of the public projects are done like this already. They have a specific bank account just for that project, such that if anything happens down the line, that they run into any problems, there's any cash flow issues, actually it protects. And he was kind of specifically speaking about it from a contractor's perspective, such that if something blows up, a company blows up, that actually kind of the little people underneath, if there isn't that facility there, they can tend to get screwed over. They are the ones they've done the service, they've fulfilled their end of the bargain, but they don't end up getting paid. And actually this is more about kind of ring fencing money, such to ensure a better likelihood of them getting paid, which of course really resonated with me from an investor perspective. Like, how many times have we seen with a specific, let's not mention any names, but gosh, I've got so many I could actually reference right here, like a developer, one project is going wrong and funds get moved from that project into another project, and there's all types of stuff that shouldn't be happening, is not right, is not legal in many cases, and actually in many cases goes fundamentally against the investment memorandum that people signed up to. There's also the, oh God, we're all off on a rant already, aren't we? There's also like the cross collateralization of projects, which no bugger mentions. But I remember being in a specific shareholder meeting in London in, oh gosh, when was that? It's probably before I moved here, 2018, 2019. And I was with an accountant who was representing another investor in this project. And as soon as there was a room full of 20 people, and as soon as it got like as a little side thing about cross collateralization, and as soon as that got mentioned, my blood froze. I must have gone pale. The guy next to me also had a visceral physical reaction, and no other person in the room seemed to be. They're just like, well, we just need to get it done. We just need to get this completed. And me and him were looking at each other like, doesn't matter if we complete this bloody project or not. If you've got cross collateralization, we're in a whole different realm of poop here. So back to PBAs. The theory, again, it's going to put in incentives, isn't it? The theory here is that it protects people, it protects the smaller contractors. But I started thinking about it, and I'm like, precisely because we talk about this so much, does this really good, it sounds great on paper, this practical solution, is that how it will transpire in practicality? Or is there any way it could backfire at all?
I've been thinking about this since you sort of sent the link over to us all earlier in the week, and I think there's probably a couple of things that sprung to mind. One is, look, letting agents have to use, and for that matter, property sources, right, have to use compliant client accounts to hold funds. Right, it's that it's ring fenced by its nature. You can't now open a letting agency without a proper client account, which the banks don't like, a lot of them, and they're moving away from, because they want one client account per client, which is insane if you're a letting agent, obviously. Just can't work. But there's a couple of businesses that have sprung up on the back of understanding that Lloyds don't like this anymore, and therefore there's actually a market there for people. But if it's enforced in lettings by trading standards or whatever, then not that I'm saying every letting agent has a compliant client account. Unfortunately, the bad ones are the same as the bad ones in any industry. They absolutely don't. But generally speaking, certainly the larger ones absolutely will do. And they're much smaller sums of money involved than what people are putting into some of these development style accounts. So that bit in itself becomes a bit of a no-brainer, really. And that would be one of the ways in which I would be selling it if it was my project to sell. The other one, which is more of a general observation, is the thing about construction is it's one of the few, if not nearly the, well, there are bastions of money laundering that still exist, right? Someone buys a shop front unit and it's open 2 minutes a week, but it's a laundrette or whatever it is, and you don't ever know this, but it takes 38,000 quid a week or whatever.
I had this exact conversation Wednesday night. Like the fact I have two stories of these. I used to work in London, just off of Wimpole Street. Sorry, I've completely stolen but I have to tell this story. And there was this French restaurant. Looked lovely, like they had like the red, white, and blue out the front, and the flowers and everything. And it always just looked dead quiet. And I always walk past thinking it must be really expensive in there if like everyone's going to Pret or Greg's or whatever's around the corner. And one day we signed off on this massive. Well, for us it was a massive deal. I think there was about £3 or £4 million profit just in the trade, because it was, we got the site, we got the planning, sold it to a housing association that we're going to build it out. And we're like, okay, let's treat ourselves to like a really fancy lunch, because we were going to go to Vegas to really celebrate. We made stupid amounts of money each out of this. And we thought, oh, let's go to that really posh, fancy French restaurant. I fancy some moule marinière, right? I thought, just go for it. Let's treat ourselves. So there's about 24 of us, the whole office, just a bunch of wanky estate agency, investment agency type people. You know, the pinstripe suits, the acting like twats. Like we're like fresh out of the 80s. If we had the big phones, it would have been beautiful. So we walk in, and there's two waitresses just sitting around on their phones, and there is, I imagine, what would have been the maitre d'. So we sit down, and they're just staring at each other. These three people didn't have a fucking clue what they were supposed to do, so they had to hire in a chef from a restaurant 4 doors down to cook stuff that was on the menu. Because obviously, because it's a money laundering thing, Wimpole Street, or just off Wimpole Street, they must have been paying £70,000-80,000 a year minimum, plus 3 people to sit on their asses playing Snake 3 on their phone, right? Plus they were buying in all of the produce, which was clearly just probably just going in a bin, which is a crime in and of itself. And the guy came in, and we waited 30 minutes for him to get a chef to come in. Then we ordered. Then an hour and a half later, food turned. We weren't leaving because we knew what was going on. So I told that story on Wednesday night, and people didn't have, they were like, I didn't know this happened. And then I told the story of a really well-known chicken shop in London. Yeah, I would say the name, but I don't know if it would become litigious. Anyway, about 15 years ago, you could get a 10-piece bucket of chicken for £3.99, which brings up 2 things, right? One is, are we eating chicken? Well, we were, and it was delicious. It still is delicious. It was chicken, but 2, clearly someone was running a business at an operational loss to offset profits in other businesses, right? So sideways loss management. But now they're massive. Now, they had like 7 or 8 branches in that kind of Harlesden, Neasden, heading into Wembley, Harrow kind of area. Now they're all over London, and I think they've gone national as well. But it happens. People are running those kind of operational loss businesses to mitigate tax profits and revenues elsewhere.
And I suppose it could be that kind of thing could be a land grab play, because that's the same thing that Procter and Gamble would do if they go into a new country or a new area that's suddenly got enough political stability for them to sell washing up liquid or whatever. So that could be slightly more legitimate than the first one, potentially. But that's definitely one of the last bastions of money laundering. We can agree on that. But one of the other ones is still the construction industry, right? Because, you buy a massive building, that bit comes with the legit cash that comes through the books. But then all the refurb works, Jewsons aren't asking for proof of funds when you pay your bills and all the rest of it, right? So that still goes on in a big way. And it's a funny thing, because the construction industry, I can't think of an industry that are harder regulated for tax these days. Reverse VAT, CIS, CITB, and the list goes on and on and on in terms. And so, of course, what that means in real life is the incentive to cheat outside of that system is much higher than it would be, because you're dealing with CIS and VAT and all of those things on a daily and weekly basis. Henceforth, still quite a bit of stuff goes on in cash, really quite a bit of stuff, given that a lot of people these days as an individual level on the street, not just in London, but around the country, a lot are not carrying a lot of cash anymore because of COVID, apart from anything else. So it does get more unusual to see people with big wads of notes around. So that side of things does not lend itself well to a light being shone upon a transparent, ring-fenced, well looked after current account. Whereas you see, if someone says to us, can we pay the rent in cash? I mean, of course, the first thing we're concerned about is the cannabis factory side of things, right? But secondly, it's also just the processing side, the cost implication side, all of that. We have one tenant who pays rent into our bank in cash, and in fact he pays it into a personal account. We transfer it over because it's the easiest way to make sure the audit trail is at least they're there and viable. And we're not taking off book cash. It's open and it's on the books, and that's the way it's got to be. So those 2 points probably work. There's one that's really heavily in support, and then one that is, is it one more bridge that a lot of the industry won't want to engage in. While it's voluntary, whilst it's a great idea, unless you think, Helen, there's enough power in the investor side of the community to say, look, I'm not investing in your projects unless it's a project bank account, or one of the bigger crowdfunding platforms gets on board with it and says, right, all our developments will have a PBA attached, but they're unlikely to want to put more hurdles in the way of their customer base, I suppose. But your mini rant is great reasons why it would be great for investors, and you might see more money invested in the sector that way, I suppose.
It would be a huge plus. Me and Marina just ran a workshop on differentiating yourself, SME level, differentiating yourself as a developer. How do you stand out when attracting investors? Well, giving your investors a more of a sense of security that the money is ring fenced. Well, there's one for a start. Something else I've started insisting on.
You're on mute, Helen.
You muted yourself in rage.
I did. Something else I started insisting on, where possible, and again, it does depend, as you say, on the amount of power or influence, or generally the amount of cash you're putting into something, is keeping an eye on costs. I will happily take on, as part of the overall costs, somebody to represent the investors in terms of a QS to keep an eye on costs, as well as, there is normally one from actually the lender, probably looking at stuff from that perspective. But very often those reports aren't shared, although we are told those reports aren't shared, or they're not able to share them. Okay, we'll just get our own then. For exactly all the reasons that you've mentioned, Adam. So anything where you can give an investor more transparency, more effectively open book, right? Here we are playing by the rules. There's nothing.
Well, that's it, isn't it? The average, this is the point, goes back to your sensitivity analysis and then transparency, doesn't it? Because in the sensitivity analysis, we should be looking at 5 to 10% over on costs. And then maybe 5 to 10% under on sales price if we're selling something, or end valuation if we're refinancing or whatever. So a more, not real time, but a monthly update in terms of, okay, so the QS said, and in any project there'll be wins and losses, but also there'll be opportunities for value engineering that you as the investors can hold. If you've got a lead investor or whatever, can hold the developer to account for and say, well, okay, well, at this stage, where are we're X over budget. We're heading for we know that the average trend is to be over cost over time, and maybe not on the GDV price. Generally speaking, GDVs tend to hold or do quite well, but a real terms, real time, because so many developers are weak on the financing side of things. I was talking to someone on Friday, and they're absolutely amazing at what they do in their lane. But they're rubbish at raising investment money, right? Rubbish at it. And I said, you just need to partner with someone who's really good at it, because I think they need this particular person. I think they'd be better off to stay in their lane. But but bring someone in who's been on your course, or someone with your level of expertise to say, right, that's managed over there, right? It's not what I do. What I do is spot the value add opportunities as good as anybody in the game, right? And work out the angles and probabilities of success and all of those things that the planning uplift genii have in their locker that I don't. And that's largely why I stay in my lane around that sort of thing, or look for someone who is very strong in that department in order to work with, if that's what the project dictates,
Yeah.
So apart from fake French restaurants and all the rest of it, what are your other thoughts around these sort of the whole bang that these guys are drumming? Jay, Piotr, what do you think? What do you think's on the? Do you think it'll work? Do you think it'll get more traction?
Commercial?
No, the project bank account approach to development.
I like the idea of it, because there's an oversight and a transparency that actually makes a lot of sense. But it only goes so far. So what I was thinking, it goes along the same lines of what Helen has said, really, is that there should be, if you're doing a development, you're getting SME money in, you're getting angel investment money in, and it's not a CIS, right? And there is an agreement. There should be a proportion of what is invested into it. The investors themselves should pay for a project manager. And that project manager is going to be auditing purchase of materials, use of materials. They're going to be auditing the progress. They're going to be doing all those kind of things. And that's a real practical element. That's real oversight. That's someone who's going to be making sure the development is progressing, so a standard project manager, but also someone that's got auditing skills, that's able to see, right, okay, this is the purchase what's the word, purchase order for these materials. These are the materials that have gone in. Because what you don't want, and Ross had mentioned this on our private group, I'm sure he doesn't mind us sharing, is that whatever's put on this purchase order, 30% of it goes into the project that you're in, 30% of it goes into a project they're trying to kick off, the other 30% goes into a project they're nearing completion, and 10% just stays there for stuff that they need in the background, right? Now, obviously, those percentages aren't, that's just
are variable. Yeah.
But I mean, it's the same thing with capital. When you have monies that are being used in multiple projects, cross-collateralized, it's the same thing with material. Material can be cross-collateralized. They can be using it in different projects. So you want to make sure that your project isn't being funded cross-collateralized with other people's money. Et al. Yours isn't being done in the same way, and you want to see the same parity with the materials. So, I mean, the whole idea of a QS is brilliant, but I think a project manager that's auditing as the development goes along.
So you could see that as kind of a bit like when you take a mortgage out and your solicitor is undertaking dual rep, and ultimately, in simple English, you're paying for it, but they're really representing the bank primarily first and foremost before they represent you. You could apply that same logic to the project manager here, where the project manager is going to be, they're on the project anyway, but ultimately their first priority is to the investors, even though the development, it's the SPV is picking up the tab.
Yeah. I think something like that is good, because then you got a reporting structure behind it. With the project business account, you as an investor, will you have access to those accounts to check them? Because obviously that in itself is an audit. So I think it goes far enough, and it highlights an issue, and I think it is relevant in the development space. But if you are a medium-sized developer and you're seeking funds from private investors and or from multi-source funds, then those lenders, those people that are offering you debt or equity, should be able to turn around and say, well, we're going to put a project manager in. That's going to come out of either the profit of the deal or the money that goes into the deal. I'd imagine the money that goes into a deal, because if the deal doesn't finish, a project manager is not going to work for free. So, but I think that's a real, and they sit separate and away from the developer and the investors, but they have a reporting cycle that has to go into both. So because they're almost, I think they need to be funded by the investors. I think it needs to go out of the investment money. So a developer would need to hive off an element of what is raised, or section it off, and that is the amount that is paid to the project manager. And it's made very clear that the contract is with for the project manager is with the investors, but the developer has to sign an agreement allowing that project manager full
access.
And that's, the more I say it, the more complicated it's getting. But I think it have more practical benefits.
But it gets even more complicated. Or the things I've seen where it gets more complicated is when projects really do go wrong, and there's again numerous very public now examples when they try to appoint one of the investors as a shareholder or a director of the company for exactly that reason. You try doing that when you're 4 years into a project and then getting on top of it. I mean, forensic accountants, eat your heart. It is a nightmare. So if you've got that from the beginning, then that's it might be complicated, but it's a damn sight less complicated than trying to reverse engineer that when you're 4 years into a project where there's all sorts going on. Just, nightmare.
Yeah, I have to say there's not much that's being said that entices me into building anything more than a garden office. And I'll be honest, I'm still having issues with the garden office. So building out or doing a conversion, just I'm yet to see that, and this is a metric that I like to use. What is the aggravation level of the profit being generated? It's not worth it. Look, it's almost already all gone. It's almost already all gone. I was talking to somebody yesterday, just a WhatsApp exchange, and they're in the process of buying a vacant building that had planning permission for a 13-bedroom HMO, but it was only converted into a 12-bedroom HMO. And I was like, yeah, I wouldn't touch it. He goes, but it's already built out. I said, I still wouldn't touch it. Do you know what I mean? It's like there's planning issues there that need to be addressed, and they're very easy to address. Still wouldn't touch it, because at the end of the day, you're still left potentially with a fully compliant HMO. But for the love of money, it's just not worth it.
Your return on head hair might not be great, but your return on beard is magnificent. So I won't worry too much.
It's stunning. And whatever the beard doesn't catch, the chest gets as well. So I don't want to just throw that out there.
Some would call it a bonus. Absolutely.
Some would call it a bonus. Yeah.
I was just flicking through some of the comments actually, Piotr. I don't know if you want to bring any of those up, because there's a couple of interesting ones on that maybe help us round this chat off.
Yeah, I think John Polo has shared something about the yield curves. 5-10 years span is now flat at 4.24%, way cheaper than the 2 years and the 30 years. And there's been a comment from Natalia. Brilliant talk. Thank you for putting perspective, things into perspective and instead of repeating doom and gloom stories from the media. Love the restaurant story.
King of storytelling.
Yeah. Look, ask for the link to the post on LinkedIn.
Yeah.
So I'll put that on the chat. I know some of the comments are not filtering through to our little kind of screen in here. But the comments that I can see is, Helen, are you running the course again from Bushra?
Yes, we are actually, and we're running it very soon, because we already had people that couldn't make the original date. We had 6 people already signed up for the next one, even without a date. So we're running it very soon, and we're also, because I'm going to be back in London at the late June, early July, we're considering doing it in person. So if anybody would prefer an in-person event, let me know, because we're just trying to juggle the logistics and the cost and everything on that side of things, or even maybe a hybrid thing. Don't know, but yes, definitely doing it again soon. So I'll drop you a message, Bushra.
There's one interesting one from that I can see on mine, Piotr, that's from a chap called Rod Milosevic. I hope I'm saying that correctly. Are low EPC affecting sales and funding? Yeah, that's it. And the bit that caught my eye of that was something I was thinking about writing about this week, but I didn't, because I'd droned on for long enough already on the supplement, to be honest. But ESG in commercial, that's really interesting. I'm solely because
what is ESG?
Environmental, social, and governance. So this is a Wall Street term that's been knocking around strongly for the past 5 years or so, and the critics will tell you it's the woke version of investment, and it's kind of there's always been that choice of, do you invest it, or that ethical dilemma of, do you invest in British American tobacco when they want to try and market to the youngest smokers that they can to keep them smoking for the whole lives, for example. And everybody falls at a different part of the moral line. How keen on you are, if you're buying the Russell 2000, how keen are you to leave out the most unethical of companies? And who's the arbiter of what's ethical and what's not? Because if Volkswagen start putting in defeat devices, which, potentially kill thousands of people, because people are generating a lot more emissions than they thought they were, should you never invest money in Volkswagen again? Just as one example, you know. But ESG, there's a massive pushback against ESG at the moment because, of course, let's just go back to the real world rather than the ESG world for a moment. There was a bit of a minor incursion over the border of Ukraine last February by Russia. And in reality, what that meant was an awful lot of gas was cut off from Europe for some time by hook or by crook, let's say. And what happened in reality was Germany, for example, started firing up the coal plants in a big way. So I think you probably could have said ESG took a little bit of a back seat there so that power could stay on and people could stay alive. And I think most of us would agree, rightly so. It's not a long-term thing, it's a short-term thing. But there's more ESG backlash at the moment than I've ever seen in the bits that are coming from the States. And there are certain things we all need to remember, because I think the woke analogy is a bit more along the lines of we're going to try and tell everybody what they should be thinking about certain matters or items, some of which are more controversial than others, right? And I think the free thinking of any part of the political spectrum in reality have a bit of a problem with that, because the point is free speech, freedom of expression, freedom of thought, right, is one of the cornerstone values of the Western world in this day and age. And one of the ways in which we differ from a lot of the Eastern world as a general rule, interestingly enough. So the ESG pushback is huge. Now, moving the EPCs towards C/B, I always said when the 2025 date was still theoretically on the table, it wasn't C in 2025 that was a problem. When you start flapping about it, getting Victorian properties up to a C is actually not that challenging at all if you know what you're doing, right? Getting them up to a B is a completely different kettle of fish. And you're definitely going to need solar to do that, right? You're going to need solar to do it. It's not going to be feasible otherwise. And so much rental stock is Victorian terrace, right? So the EPCs still, Rod, in my opinion, are not having the impact that they should on the pricing. The government, as usual, want to try and control all this stuff by legislating. So EPCs will in future, or they already do, attract small discounts in terms of the rates that people have to pay on their mortgages. They'll attract premium on insurance if they're lower EPC. They want to address all this, if you're not aware, on the industry players sort of side by requiring the lenders to have a loan book that averages EPC of C by, say, 2030. So you're going to need to incentivize Bs and As to come into your book to offset any Ds and Es. And you're going to end up penalizing Ds and Es because it goes back to our incentives conversation, right? So that's potentially problematic, because if it's a terrace house in the northeast, not to stereotype too much, but is of lower value, there's less of a business case to put the improvements in to make it to a C, especially if a B is on the horizon, which is never going to be reached, and therefore it's going to be divested because it doesn't stack up. Whereas, you know, if it's a terraced house in Fulham and it's worth 850 grand or whatever it would be worth these days, you know, cheer up over spending 20 grand on the upgrades, really. But if it's worth 30k in the first place and the 20 grand's the same number, it's not going to happen, is it? So I'm not convinced that ESG is quite through the way, the truth and the light quite yet. And of course, I upset quite a few people a few weeks ago with a supplement that was talking about the reality of renewables and nuclear power and all the rest of it, which again just comes from a place of data, not a place of ideology or a place of not really my opinion. It's saying, look, you'd have to do so much to even scratch the surface of a third of the world's energy demand by 2050. You have to do so much more than we're already doing. And a lot of this stuff is not necessarily financially viable without government incentives, which badged in a different way means taxpayer money, which, in case you haven't noticed, is quite thin on the ground at the moment, despite the very, very high tax regimes that a lot of countries are facing. I don't know that ESG is home and hosed yet, and is quite I'm not quite placing it in my it's the final answer to these problems. You know, companies and people absolutely want sustainability, right? It's one of the things that people drives consumer behavior. But when a building is built, right, than spending inordinate amounts of money that are not commercially viable on keeping it the way it is. If the alternative is to not use it or to have to knock it down, neither of those sound like better alternatives to me. So that's the danger the ESG train, sort of the path that it paves, in my opinion.
Really good point.
Jay looked like he was about to go on a potential. I invited him in there with a couple of tidbits, I think, but he's avoided the crumbs.
There were a couple of rants. So the first one is you mentioned nuclear. Everyone's obviously heard the dam that's been busted in Ukraine, right? That's flooded those villages. You know that water source was super cooling a nuclear power station. So the ramifications, fortunately, I think the majority of people evacuated the villages fairly quickly. So limited loss of life there. But the thing with nuclear fission is it tends not to stay cool for very long unless it's surrounded by materials that keep it cool, which is a larger problem, which I don't think you've really read on the news. Fortunately, I was going to talk about not the ESG. I was going to just, my house I think is like a B+ EPC. It's quite high. It's fairly new build-ish, but I still thought, well, I want to get some solar on. So I got some people to come out, and they did an assessment. But it turns out the amount of sunlight my property gets makes solar completely unviable. And I wonder how many, especially in urban, tight-packed areas where you've got houses like parts of Liverpool where it's back to back, you're going to have this much sunshine for 40 minutes a day that's going to be useful, right? And then you've just got the buildings like mine where it's I think we're east to west facing rather than north to south. So the sun, it doesn't really get much. And there's a massive tree. It's a beautiful tree, but you wouldn't advocate snipping the tree down for the sake of, do you know what I mean? So I was going to just mention that as
they're actually, I don't know if you've seen them yet, but they're these vertical panels that are being trialed in general these days. They look a bit like super modern chimney stacks sort of things, so that you can try and make things work. But of course, like everything, financial viability that's not going to work today unless you've got grant money to do it. And this is part of the sort of, not necessarily anti-ESG, but the pushback argument against it is this stuff is not good value for money, right? We need to do more research. We need to throw more money at R&D, right? Do the R&D first, accelerate it, use AI, use everything you need to for the next 4 or 5 years, and pump all the incentives into that. And then we need to deploy. And this should be the whole point of the conversation of by 2050, this is what we need to do. But instead, people are floundering around sprinkling orange dust on snooker tables. And as we've said before, misdirecting the issue, which stops the conversation being the right conversation, which is just so frustrating.
Yeah, and the final point I was going to make about what you had said was around the ESG, which I was going to say it's something that's kind of makes people feel like they're doing something good, keeps them warm and fuzzy, ticks a couple of boxes. But the reality is it only survives as long as the needs must element doesn't pop in, which is exactly what happened when that incursion on the pipeline happened, and Germany had to then start firing up old coal processing plants and reaping start. It's fine until the needs must. And you'll find that with a lot of things.
But really, thank goodness the world still works like that, because there are members, there are aggressive members of certain movements that would prefer you didn't have the ability to ask questions or do anything around any of that. So it needed to happen, and the balance has righted itself relatively quickly, and rightly or wrongly, it's capitalism that did that with liquefied natural gas and all the rest of it.
Yeah. Those were my piecemeal statements about your chat in general, but agree on all points essentially.
Another great comment from Aman as well. Generally, solar is not viable for terrace properties. It works better on semis and detached ones.
Yeah, tiddly little roofs, and you can only get sort of 2 and a quarter kilowatt systems on things like that. But of course, again, that's a little bit back to the R&D point, because okay, so what we need is panels that are twice as efficient in the same space, right? And then we can generate enough. I mean, the frustrating thing about solar on any sort of scale at the moment is the distribution network operator turns around and says, no, you're not allowed that much solar on the roof. It's not going to happen. We can't cope with it in the grid. Once again, comes back to where the investment needs to go in order to make this work over a 30-year term. But you've got to depoliticize this to make it workable, not piddle about with, Keir Starmer's ideas are better than Rishi Sunak's or whatever. It's like, yeah, well, both of them aren't going to be around for that much longer, I don't reckon. So let's see what happens.
I had a really cool idea, and it's probably already been done, because it's just one of those things that you think about when you're doing something where you're not really paying much attention to everything else. But years ago there was this definitely wasn't criminal damage. I'm just putting it out there. This wasn't criminal damage. There was a building near this estate that we were on, and it had fallen into complete disrepair. Like literally, it was being taken over by nature. And we used to go and play in it. Obviously, being younger people, kids, you see something like that, you see a really interesting playground. So we went in there, and they had this like satellite dish, and the satellite dish had fallen down, but it was like still facing upwards. It was the middle of the day, and we went to touch it, and it really could have burnt us. Like this satellite dish was so hot, I think, because of it was kind of like the sun was just going in there, and it was kind of like being held in there. So I was thinking, what about getting like satellite dish / solar dishes where you could put them on the property and specifically angle them at the point where they're going to gain the most amount of sun, or have them like most plants do, where it tracks the sun over your house. So you don't need the whole roof. You have this kind of circular concave rather than concave kind of thing, rather than convex. Concave, so it's going inwards, and it basically, they set it up on your roof or on the side of your building, and they do a 24-hour survey to see where the sun comes, and then they just input it into that dish, and it follows from like dawn all the way to dusk. Like it just tracks, and I think that would be super cool. Trademark, copyright, tested and patented by J. Howard Industry Incorporated, LLP, PSG, NLTAPS. So that's my idea. I don't know if someone's done that, but I think that would be a really cool way on terrace properties, on properties like mine, where actually the sun in the garden is really nice, but you're not going to get a lot of it over the actual building, because the building next to it, the tree next to it, the actual house is in darkness. The front and rear garden are bathed in beautiful sunlight at the moment. But that's an idea. Let's see if that picks up.
Love it. Wow. Genius.
Wow, selling it like that publicly, Jay.
Well, it's open source now. Now people can turn around and go, the guy who solved the energy crisis? It was Jay Howard. Did he get a penny? Did he not? No. This guy is like he's the Tesla. He's the Nikolai Tesla of the 21st century. You're welcome, ladies and gentlemen. Take that away with you.
Wow. Okay,
I love the fact as well that we lost Adam because his device overheated when we're talking about solar energy. That's just, the universe has a great sense of humor.
Yeah, well, I think today's chat was really diverse and interesting. As another comment from Rod, great idea on solar satellites. There are now clear solar glasses that are for windows, though, mainly used in commercial.
Interesting.
Oh, that's still really cool. Could you imagine having the shard with the glass all like that? Like the Burj Khalifa and like massive buildings. Like most of New York is mainly giant glass buildings.
Yeah.
They could export the excess energy to countries and places that need it more, perhaps. It sounds a little too humanitarian for the Americans, though, so maybe not.
Brilliant. Well, thanks everyone for contribution today. And I know there's some comments that we didn't see in the main chat, and they might be on like Jay's post, on Helen's post, that we can't see in here. So if we didn't come back to your questions or we didn't read them out, we'll try to respond to them throughout the day. And yeah, anything else to add, guys, before we wrap up?
Well, Michael Wright has just put a comment in, which has broken my heart. It's already been invented. Michael, like I said, I had no idea, but what a brilliant idea. I'm now going to start looking at the smart flower. That sounds super cool.
Nice. Smart flower. And get your pitch ready for Dragon's Den, Jay.
That's it. That's it. Yes, Aman. Yes, let's do this.
Brilliant. Okay, guys. Well,
Have a
have
great
an amazing
weekend.
Sunday.
Thank you, everybody.